Good morning, everyone, and welcome to what I've now titled, It Might Be This or Might Be That. These are our morning notes on trading the S&P 500 futures today. My name is A.F. Thornton. It is July 1st, 2022. Can you believe it? 1st of July, we're well into summer, and today is the most reliably bullish day of the entire calendar year, at least based on the last 21 years of data. So welcome to that day that we can all count on to go up, right? And actually, it normally spills into the next 9 trading sessions. So the first 10 trading days of July are reliably some of the most bullish days of the entire calendar year. And that's where we get the so-called summer rally that we hopefully rely on every year. Now, one thing I pointed out yesterday in the afternoon notes is, and this is something that really tells you the difference between an amateur and a professional trader. Traders often forget, whatever setup they're using, whatever they read in the books, that one of the most reliable indicators that a trader has at his or her disposal is what I call when what should happen doesn't. WWHSD. I'm not sure who coined the acronym, but it's a great acronym because most traders, when a trade fails, basically just scream at their computers, throw something at their screen, but for the most part, abandon the trade. Yet, when you have a reliable setup or a reliable seasonal pattern that doesn't work out, a true professional trader uses that as a contraindicator and, if appropriate, reverses the trade. So if you were going to go long this morning because this is the most reliably bullish day of the year and the market goes against you, that is telling you something. Obviously, it's telling you something's really wrong. So I always want you to keep that in mind. We should be having 10 awesome days here. And actually, the market's set up for it. I mean, we're certainly not oversold from a bear market perspective, but certainly we're in a zone for a bounce, and maybe we've already had it. Maybe that was it. But keep that in mind today. So from a seasonal perspective, we're looking for some bullish behavior. Overnight, the market traded inside yesterday's range. We're going to open, although it neither was able to get to yesterday's low, nor was it able to get to yesterday's high. And actually, if you look at the profile here, it is, let me just show you real quick. Here's the overnight range. Here's yesterday's range. Looks like we have a high volume node at 37.55 or so. No surprise, those, the 50 point and 100 point increments, I call them the roundies and half roundies, are always where a lot of stops and options will be set. So it's not a surprise to see that level providing some sort of volume. And the other one is the 37.75 level we've been talking about for the last week. So that continues to be, actually, if you look here now, this is the overnight profile. This is yesterday. That is the day before. But over here is the cumulative volume profile of the last 30 days. And what you'll see is this 37.75 area is the key area in our vicinity today. And the market has basically been balanced. You can see some symmetry over here. The market's been balancing around that level. So, I guess one way to look at it in auction theory is this is too high, this is too low, this is just right. So for now, that's what we're dealing with. But basically, we didn't find out anything from the overnight activity that might help us. I talked yesterday about the walkaway trade. That was obviously very successful. But let's just take a quick peek at the monthly chart here, and then we'll wrap it up. This is a monthly chart of the S&P 500 continuous futures contract. And this was the last bear market in 2008. Here's where we are now. So comparatively, if this is a secular bear, we got a long ways to go. And I think it is. That's just my opinion. I could be right, I could be wrong. Nobody's got a crystal ball. Here is the 2009 to present bull market channel, right? So here's the month we just ended. Now, it was an ugly bar for the month, and we closed at the bottom of the bar. You never like to see that. But compared to May, we really didn't achieve much new ground on the upside. In fact, in one way, you might look at it as we ran the May monthly stops and came back to the May close. So it is an ugly bar. We didn't get any follow through from the so-called doji bar of May. But in any event, we didn't gain any great new ground on the downside. So in a sense, we're retesting those May lows as we speak. And we came down to mid-channel, which is not unusual in a bull market. I suppose if we're going to continue the bull market that started in 2009, there's every argument that we can still keep traveling up this channel. However, that's not my best judgment. My best judgment is that we're now dealing with this 100-year price channel, which is what you see outlined in the purple here. And this is that channel. And going back to our current market thesis, which is up on the blog at our website at blueprintquantitative.com. Blueprint is, we dropped the E just to make it a little more unique. So blueprint without the E, quantitative.com. Go to the blog section, look for the current market thesis. And what our thesis is this was a 3 sigma move off the long-term channel, which is here. That's only happened 2 other times in history, 1929 and 2000. And we are just simply expecting a regression to the mean. And the mean of the 100-year channel is here around 2,500. So that's our target for this bear market. Maybe not quite as bad as 1929 or say this one in 2008, but still about a 40% clip or loss, however you want to describe it, down to this level. Now, that's regression to the mean. The market doesn't always go to the mean. Sometimes the market overshoots the mean. So that is a risk on the table. And that's certainly, 1929 is one of the few times we saw the market go from, say, the top to the bottom of the channel in a very short period of time, a crash that was, erased about 80% of the market. Not forecasting that here, just, one of those things you want to be aware of. But at least in traditional regression analysis, mid-channel, 2,500, that's also about, somewhere in the vicinity of the COVID lows, where in March 2020, I don't think we'll go quite that low, but certainly in that level. And I think right now we're working our way to test the breakout from February 2020. So this is a February 2020 high. We went into the COVID crash, and this is where we broke out. By the way, I'll work on getting this cursor a little bit better because I'm noticing it's not so easy to see on YouTube. So sorry about that, and I'll work on that for future videos. So anyway, since we just closed the month of June, we closed the calendar quarter, I wanted you to take a look at that because I think, knowing where you're headed is half the battle. So I guess the other thing I wanted to just highlight, let's go over here to Zero Hedge real quick. Just hit a few headlines. There's a lot going on out there. We see nothing but bad news. There's some discussion about how these reverse repos are working. It's costing the Fed basically $100 million a day to run that operation. There's just, the whole situation in Europe. lot of negative headlines here, and quite frankly, in my lifetime, I've never seen similar risks like we have today. So, the backdrop's fairly negative, and it's real. I mean, this isn't just, rumors or anything like that. It's a pretty real situation. So I'm always keeping that in the back of my mind. I think Zero Hedge is a great tool for that. Let's go over to look at some of the headlines this morning. We've got a little bit of revision on the manufacturing PMI, ISM, a couple things coming out today, but it's Monday. Or actually, we have a holiday on Monday, but next week is where it gets crazy because we're going to have all kinds of economic data, including CPI. And then, of course, we're going to jump into quarterly earnings, which is going to be interesting in and of itself. So enjoy your holiday weekend because it's going to get wild when we get back. I mean, wild. So where are we for today? We flip over here to an intraday chart. Nope, you can't have my passwords. Remember I talked about the cradle trade a few sessions ago. And basically, this is something that develops on our algo where we get our first move out and buy signal, and then the market will reset on the trigger line here. And I think if you want to be bullish, that's the most bullish outcome I can see for today, that we get some follow through from this rally, maybe an A, B, C. I still think that we have that possibility of tagging 4,000. Now remember, there's still options expiring today, so the expected move low, which sits around 38.18, should still be operating. We watched that act as a magnet yesterday to bring the market back, so I don't want you to forget about that. But in any event, I think this is what, if we want to be optimistic or bullish, this is what I'd be looking at to see if we can get this cradle trade and move out for at least, a rally up to the high that we saw this week, possibly up to 4,000. But from a reasonable forecasting expected, the rally could take us up even to these levels here around 41, 4,200. So I don't have a crystal ball. I can't tell you what's going to happen. What I can tell you is if you're with us over in the trading room on Tuesdays and Thursday, you will watch how we can actually see in real time whether these forecasts are being confirmed and make adjustments accordingly. I am primarily a price action trader. I don't like to have cluttered screens. That's why I use expected moves to create a windshield for what I'm going to expect either today or next week. The volatility has still been relatively high. We're seeing 1.25% expected moves every day. We had over a 200-point expected move for the week. This week we chose to go to the bottom of it, but who knows? The most reliably bullish trading session of the day, why can't we just take this thing from here as high as the moon, just like the old days? Boy, were those fond memories. So anyway, that's the deal as we go into the 4th of July holiday weekend. Even though we have options weekly expiration today, I would expect volume to taper off this afternoon as everybody kind of takes a break from all this. It's been a crazy. I mean, I think most of you are probably reading the headlines. The worst start to the stock market in 50 years. The worst start to the stock market for the NASDAQ ever. So the first half of this year has been brutal. I think the S&P is down 17% for the quarter. But those of you who've been in our swing trader strategy subscribers, and again, you can find out more about that over at the website at blueprintquantitative.com. Most of you who are in that, or all of you who've been in it from the 1st of January, are up over 90% if you followed the trade. So not a bad first half of the year for us. Actually, that's kind of low for us, to be honest. But I've been very, very cautious and very careful about taking especially swing trades since the 1st of the year, because basically that's when the market peaked. So anyway, that's enough for now. Again, thanks for joining me here at the might be this or the might be that forecast. Hopefully, I've been a little more specific than that. And have a great weekend and a great trading day. And I'll be back on. Well, we'll have our Sunday night forum. And I think let's do that Monday night since it's a holiday weekend. So we'll have the Monday night forum, which will go on about 6 p.m. Eastern Standard Time. And when in that forum is when we look at the week ahead, take some questions and answers, and again, kind of create the roadmap. And then, of course, every morning, pre-market and post-market, we'll have our little brief podcast. And then you can join us in the trading room on Tuesdays and Thursdays. Again, just a quick precatory note. I didn't put the language up today, but let me just say, don't take your advice from the internet. Trading is a very risky proposition, especially trading futures and options. So you have to know what you're doing, and this channel, like most channels, is for educational purposes only. It's not meant to be investment advice. So always keep that in mind. And we're new to YouTube. We're trying to build a great community here. I've been doing this for 35 years, but, sort of in the old dark ages, haven't really tried to do much on YouTube or Rumble or any of these channels. So this is kind of a new adventure for me, although I'm enjoying it thoroughly. But we do need your help. If you like what you're hearing here and it's useful to you, please hit the like button. We'd love to have you join the channel and our trading community, so you can do that also. And obviously, if you want to be notified about these, not only the regular little webinars we do here, but some of the impromptu ones based on current events, be sure to hit the notification button so that you're notified every time these new podcasts come out. So at any rate, have a great weekend ahead, and love to have you join us here. And thanks.